Area of the market that is seeing huge demand. Investors seem to be piling into junk bonds as they look for yield as Treasury rates have been dropping as of late. The rally in junk bonds has pushed yields to record low levels, so low, in fact, that they're now below the inflation rate for the first time on record, going all the way back, as you can see there, to 1986. So is all this demand, this hunt for yield, creating a risk that we may be ignoring? Let's ask Michael Contopoulos, Director of Fixed Income at Richard Bernstein Advisors. Michael, you just heard the conversation we had with regard to our equity and bond panel. There is choppiness that Nisha Patel is expecting. Is this the reason why we are seeing maybe a little bit of activity on the Treasury side of things, but not as much on the high yield side?
It's a good question, Dom. I think the high yield market and the credit markets in general are telling you that the growth slowed down, that it appears that the Treasury market has priced in over the last week is overdone. You haven't really seen credit spreads widen all that much. And as you mentioned, all-in yields are at historic lows. One thing that I would make sure I stress is I think comparing high yield yields to real yields is a little bit, maybe not the best thing to do given the current environment. We all know CPI is very high at the moment. We all know there are base effects that are affecting CPI. At RBA, we think inflation is likely going to be higher than normal and more persistent than people expect. But we don't expect 5 or 6% inflation to last for all that long. So your real yield for high yield is going to go up over coming months. But having said that, listen, there's no doubt that nominal yields or the absolute level of yields are historically low. That's a large part because of A, as you mentioned, reach for yield, but B, also much more improving fundamental picture for the high yield market and for the corporate market.
So I'd like to stick on that point right there because we can talk about other parts of the fixed income market. Treasury obviously has some real issues around, the Fed and central bank intervention, bond buying programs and whatnot. But oftentimes you look towards credit, not just investment grade, but specifically high yield as an indicator of possible stress down the line. And it's showing nothing right now, right? I mean, we can talk about equity markets, maybe trying to correct a bit, but junk bonds have historically shown us the way forward. They're not doing so now. Is that justified?
Yeah, I think it is justified, Dom. It's one of the reasons at RBA, we still are levered to the cyclical trade on the equity side as well. The high yield market does do usually a phenomenal job at indicating risk before equity investors have figured it out. When you look at high yield, leverage is collapsing, earnings are accelerating, and the default rate is plummeting. We had a 9.5% default rate in the United States in 2020. That has already plummeted to roughly 2.5%. And our model suggests that within the next 6 to 12 months, the default rate likely falls to 1%. And as a high yield investor, one of the things that you want to look at, perhaps the most important thing you want to look at, is how much yield or how much spread are you earning relative to the losses you may take because of defaults. And since defaults have plummeted and since expectations for defaults continue to decline every single month as those earnings accelerate and as companies have very low interest payments because of the absolute level of rates and the fact that they've termed out their debt, as all of this is happening, even though yields are very low, the compensation you're getting for expected default losses, particularly in early maturity, 0 to 3 year type maturity paper and high yield, still actually looks pretty attractive. The fundamentals are strong.
Shepard Smith here. Thanks for watching CNBC on YouTube.